Hello, everyone. Welcome back. This is macroeconomics. We are basically having today's lesson to talk about our first macroeconomic model. So, in the previous lessons, we have been talking about the measures of this macroeconomic um, indicators, such as GDP, unemployment rates, and also inflation. We also talk about the importance of financial markets because the financial market it's basically the foundations for the allocations of saving, the national savings that goes into investments in the country. So we also talk about the investment and saving identity and figure out how the investment it's being used by the firms when they actually plan for expansions in the future. So all this actually connected to the later in the later model that we are going to discuss. But of course, today we want to mainly focus on this one model called the income-expenditure models in chapter 11 of our textbooks. And we would like to put some of these things that we learned from the previous lectures and put them together and trying to make a model that can help us understand a little bit more of the allocations of the resources in the macroeconomic study. All right, so in this chapter, we are going to discover several new concepts and topics. So there are topics talked about the multiplier effects in the economy, how we define the consumer spending, what the consumer functions will look like, and the investment spending, what we define as planned investments and unplanned investment spending, and how inventory is actually related to those topics. Of course, at the end, we would like to build a very simple income expenditure model in this demonstrations so that we can at least get an idea. So in this lecture, we are going to use the simplest model first. We set up the economy only with households and firm, and later we're going to expand it to a bigger model. All right, so to begin with our model setup, we are going to learn a few terminology first, and we would like to use these terminologies to describe the behaviors of the economy in the later slides. So first of all, we would like to learn this term right here called aggregate outputs. So the aggregate output is represented by this letter Y here in our model. So the aggregate output basically refer to the aggregate productions, outputs of the economy. And now we are going to also define another term right here called planned aggregate expenditure. So the planned aggregate expenditure is represented by the notation AE right here. Later we're going to see how they going to show up in the model. But for now, the aggregate output basically is the total amounts of goods and services that we produce in values of dollar. And the aggregate expenditure in this model, it's basically representing how much goods and services that all the agencies in the economy would like to purchase in the economy. And in the macroeconomic study, we always know that the aggregate outputs Y should always equals to the aggregate expenditure. And this is basically the macroeconomic equilibrium we are trying to get to in our model. And this equilibrium has its specific meanings. So again, well, just to recall, in chapter 3, we learned the supply and demand models. Any equilibrium definitions basically suggesting there is no tendency to make any changes. So same here, when the economy actually getting to this point where aggregate expenditure equals to aggregate outputs, it's basically another equilibrium, a stable point in our model, where the economy will just stay put and not making any changes unless there is another thing is changing in the model. So some technical details right here. So we are going to define the economy with not only just the purchase by the households, which is consumptions. We also know that the firms and businesses in the economy also purchase goods and services to invest for the future productions. And in this particular case, we also basically define the inventories that the firm stocks. It's part of the investments for the firm to pay. One way you can conceptualize this is when the firm trying to produce, let's say, some additional units of outputs. Let's say a car producer, they actually plan to produce the car 100 units this year, and they would like to sell or plan to sell only 80 units of cars this year, and leaving 20 units of cars to sell in the next periods, let's say, well, next year or maybe next quarter. The 20 units that the firm planned to sell in the future periods, it's basically what we call the inventory. And this inventory is basically the production take place in the current periods, but not going to sell for the within the current periods. So one thing that we have to note is the definitions of investments is basically the money spent by the firm in the current periods to expand the future productions. In this case, if the firm actually produced extra 20 units of cars for the next period to sell, the amounts of money that the firm paid this period, it's basically invested for the productions in the future. The 20 units of car, it's basically the extra units of car that the firm can sell without running any productions. So that's why this planned inventory is basically what we also included in part of the investment spending in the economy. So the planned investments basically include any planned change in inventory. So if the firm stored 20 cars to sell next periods, well, this is the planned change in inventory. So this is already planned out. This is what the firm actually want to invest in the future. And that's why we call this also planned investment. But the planned investment not only just include inventory, so you have to be very careful. So the change in inventory planned by the firm, it's only partials of the planned investment. So there are other types of investments, like maybe the firm investing money on providing trainings to the workers. It's also part of the planned investment spending. So the inventory, it's only partial of this total investments planned by the firm. The equilibriums that we described earlier only occurs when the planned change in inventory equals to the actual change in inventory. So what it means is when the firm actually planned it, they planned 20 cars to sell in the future periods. And when the next period comes, the actual inventory actually has 20 cars left so that they can sell those 20 cars in the new periods. This is basically the condition we say, well, the planned change in inventory equals to the actual change in inventory. However, as you can imagine, even for a very sophisticated company like Apple's or Google's or maybe even Nike's, where they're selling the products in the market for so many years, it's very difficult for them to actually plan an exact quantity of inventory for the future periods. So as you can imagine, this planned inventory might not always match with the actual change in inventory in the reality. So that's why we would like to later investigate, hey, what if the quantity of inventory is not matching with what the firm planned it for, and how the firm actually reacts. And now we say, well, when the planned investments equals to the actual investments, then there will be no unplanned change in inventories in the economy. That means, well, when the firm can accurately plan out what they need to sell this period and what they have left to sell for the next period. Now let's define what we mean by aggregate expenditure here. So we have learned about the expenditure concepts in the previous chapters, and we know there are four components that add up the total expenditure in the economy. So the first one is called the consumptions. So consumption is done by the households. Households is the one who spend money on consumptions to buy goods and services they need for everyday needs. Firms and businesses will spend money on planned investments, which is I, and those are the goods and services that allow firms to expand the productions in the future. We also have the G right here called the government purchase. So government purchase is the goods and services purchased by the governments to provide the public services in our economy. And the last one here is called the net export. So net export is basically the total amounts of exports minus imports. So it's a international transactions. Well, here we define the aggregate expenditure in the economy should always be equals to the total amounts of consumptions, C, plus total amounts of investments, I, plus the government's purchase, G, plus the total amounts of net export, NX. So this is basically how we define the aggregate expenditure. And now we would like to actually be a little bit more specific on this term. We don't want to just say this is the aggregate expenditure or total expenditure in the economy, but we do want to actually specifically define this AE term is the planned aggregate expenditure. And the reason is because there is one component in the four that has this planned elements in there. So consumptions, government spending, net export, those are the ones that you can actually see how they match with the actual number. But the total values of investment spending might not be the same as planned in a given period. So just like earlier we said, sometime when the firm planned to have 20 units of car in inventory, but by the end of the period, they might not be actually have a 20 units of car, or maybe they will have more than 20 units of car. So that's why firms had this planned investments, and this planned spending might actually turns out not to be the actual spending or the actual expenditure in the economy. So that's why we call this AE term the planned aggregate expenditure. Now let's take a look at this relationship between AE and AY so that we can get an idea of our model logics. So here we would like to actually make cases and trying to see how firms and businesses react to any mismatch of the aggregate expenditure and aggregate outputs. So for instance, let's say we have an aggregate expenditure in the economy that is greater than the GDP. So in a simple case, I can give you a very simple example here. So let's say there is an economy, and the economy currently is running by just one firm, which is a firm selling books. So this bookstore actually produce some books and sell in the economy. And we basically refer the term GDP, which is the total values of goods and services produced in the economy, which is the aggregate outputs, the total amounts of books produced by the firm. And we also define the aggregate expenditure here. Actually, we call this planned aggregate expenditure, which is the total amounts or total values of books that everyone in the economy would like to purchase. So in this case, when the aggregate expenditure is greater than the aggregate output, GDP, we're basically referring to the case where the firms, let's say the bookstore, produce 100 books, and the bookstore set aside 20 books for the next period to sell, so that this current period, they have 80 books to sell. And they open the store today, or this particular period, let's say a quarter, or maybe by year. So they start selling the book at the beginning of the year, and then they keep selling the books. 80 books were all selling every single month within this period. And by the end of the period, let's say by the end of the year, the bookstore actually find out that they have more people, they want to buy the books that they put out on the shelves. So there was still a long lines in this bookstore and trying to buy the books, but they already sold out all 80 books. So the planned aggregate expenditure is greater than GDP or aggregate output. It's when the firm facing a conditions where they plan to have a certain inventory and their current stock to sell, but people are so motivated to buy the goods and services that they don't have enough to sell in this current period. Well, the logic is pretty simple. When firms facing these long lines in the store, they cannot reject their consumers because, well, the firms only has one objective to sell their goods, is to maximize profits. As long as someone is willing to buy those books from the bookstore at a price where the bookstore is making profits, the bookstore should think of a way to sell their books. And fortunately, they do have some stocks in the inventory. So this is the time where the firm actually start pulling the inventories out and trying to sell the books in the current period. So in this case, the inventory will decline. And at the end, what happened is the firm, they basically selling more and more of their books from the inventory, and they see that the books that they produce for this period is not enough to satisfy the purchase of the people in the current period. So when the next production period comes again, firms and businesses will realize, or they will review the previous period. They might find out that, hey, it's time to boost their production because, well, people want to buy a lot of the books. So that's why GDP and total employment in the economy will ultimately expect to increase in the future periods. So intuition is when the firm seeing the inventory goes down, they will have to produce more goods in the next period so that they can catch up with the demand for the final goods and services in the economy. On the other hand, we can basically think about the story in the reverse. Let's say when the aggregate expenditure is less than the GDP, the aggregate output. So this is the time when the bookstore actually produced 100 books this period and set aside 20 books. And the bookstore trying to sell 80 books this period. When the aggregate expenditure is less than the aggregate output, that means people want to buy less than 80 books this period. So by the end of the year, the bookstore actually find out there are extra 10 books left on the shelves no one wants to buy. And of course, the bookstore is not going to throw the books away because they know they can still sell those books in the future periods. So what happened is the bookstore will stock up the current inventory with this 10 extra book on the shelves. In this case, the inventory level will go up. Well, when the firm trying to review the current production and trying to plan for the future productions, the bookstore might end up realizing, hey, you know what, people are not very interested to buy their books, so maybe they should reduce the productions. So GDP in this case will decrease in the future, and because the bookstore do not need to produce that many, and total employment will also decrease. So again, the intuition is when the firm see their sales go down and seeing their inventories to go up, they will adjust the production level and reducing employment in the future. So now we have basically two very intuitive stories about how the economy reacts to the changes of aggregate expenditures and aggregate outputs. We would like to go further down and try to see how this story might be able to get into the model so that we can find that one steady point. So just a reminder for everyone. So we have the aggregate outputs, Y, that would present the GDP, the total productions in the economy. And we have the planned aggregate expenditure, AE terms, that will represent all the spending in the economy. And the macroeconomic equilibrium should always happen when the planned aggregate expenditure equals to the aggregate outputs. So let's make some assumptions so that we can actually reduce the complexity of the model and trying to focus more on the logics of the model first. So we would like to build a model with those assumptions here. We would like to build an economy that has no government. So that means no one is taking tax, no government is spending money, and no government is actually reallocating the money from the households back to the households, no transfer payments. Also, we're building an economy that's a closed one. So we do not want the import and exports get into the model yet. Later, we can relax those assumptions, but for now, we just want to build the easiest one. And also, number 3, we assume prices and interest rates are fixed. So when prices are fixed, people do not need to worry about the change of prices or inflations in the economy. And when interest rate is fixed, which will also suggest that the firm and businesses will not have concern about the cost for borrowing money to invest. So with those assumptions in hand, now we are going to build the simplest world possible for this income expenditure model. So with this simple world set up, we have only 2 agencies left in the economy. Number 1, the households, and number 2, the firms. And also, we have only left with 2 types of spending or expenditure in the economy, which is C and I. So now, this economy will only have a planned aggregate expenditure with the combined of the consumptions and investment spending. Now, we would like to define the consumptions and investment spending a little bit further. So we define the consumptions to be C. So this consumptions, it's basically the how much the consumers will spend to buy goods and services. And we assume also that the aggregate outputs Y, and also it's referred to the aggregate incomes. It's basically the income received by the consumers or the households. When the total amounts of income, the aggregate incomes, increase or decrease, we believe the consumptions will somehow be affected. So this is a very logical assumptions here. So if you think about yourself, when you have only $1,000 per month of income, you can think about how much of that income you will spend on buying goods and services, as compared to, let's say, to the extreme, let's say you have maybe $50,000 per month of income. So the total amounts of consumptions made by the households will definitely related to their incomes earned. So we say maybe there is a relationship between consumptions and aggregate outputs, or maybe what we say aggregate incomes. And specifically, we are using a mathematical term here. C is a function of Y. So to put it into a very easy way, we basically say that there is a positive correlation between consumptions and national incomes. So when income goes up, the consumptions in the economy will also goes up. When the income goes down, the total values of consumptions in the economy should also go down. So if we actually say that there is a correlation between the two, and the correlation can simply by a representation of this line right here. So this line right here, basically it's what we call a consumption functions in the economy. So this line basically gives us an idea, given a specific amount of income, there will be a specific amount of consumptions in the economy. And as Y increase, C will also increase. Well, if the theoretical model is too vague to believe, maybe we should go back to our historical data and try to find the behavior of the consumptions to our income. And this is what we're going to see here with the US data. So in this graph right here, we are basically plotting out the data points from each year, from the year of 1960 all the way up to the current year, 2014. You can actually see there is a change of real disposable income in the economy, and also the real consumption spending in the economy. So as the real incomes increase, you can see the real consumptions also increase in the economy. And on the right-hand side graph, you can almost see that all the data points can be very, very perfectly flipped into this straight lines. So the idea is we want to actually think of the behavior of the incomes and consumptions in the economy, and the data, the historical data, actually suggests, hey, maybe our assumptions here it's actually what we described. So let's say we do believe that there is a consumption function that behaves very similarly to the previous graph. Now we would like to also define the planned investment spending in the economy. So we assume that firms will plan their spending by the beginning of each terms. So for instance, when Apple, they are trying to think of like, should they invest on a new product? They usually will plan out the budgets ahead of time. They won't actually say, hey, this year we are planning to spend no money on new project, and all of a sudden they will change the plan by June. So firms usually will plan the fixed amounts of investment spending budgets at the beginning of the year. Well, same for the planned inventory. So inventory, it's also planned ahead of time. So when firm actually plan to invest $100 billion at the beginning of the fiscal year, the planned investments will not be affected by any factors happening in the economy. Especially we are fixing the interest rate fixed in this simple world, that makes the firm decisions a little bit easier to understand. And remember, the planned investment is not equals to the actual investments at the end of the year. So we have to be careful with this. And we would like to use an example later to find out, well, what is going to happen when the planned investment is not equals to the actual investments. Now, simply, if we think of investment spending, it's basically a fixed amount that the firm will ultimately going to spend after they figure out the costs and benefits for borrowing money. Then this investment spending, it's basically just an additional number on top of this consumption functions. So what it means is mathematically, we are basically just adding a number on top of the consumption functions. Since the consumption function is a straight lines functions, we have the slope, we have the intercept. If we're adding another number to it, we are basically just shifting the lines up by whatever the amount it is. So in this case, the aggregate expenditure functions, it's basically the blue lines above the consumption functions in the green lines. Now, just to remind you again, the ultimate goal for today's model demonstration is to find that macroeconomic equilibrium, where the aggregate expenditure equals to the aggregate outputs. So now, if we are going to try finding that equilibrium, we can now conceptually think about the planned aggregate expenditure is always equals to the consumption plus the planned investment. And ultimately, the sum of the two should equals to the aggregate expenditure, the aggregate outputs Y, or the national income Y. Well, the easiest way to visualize this, it's using a tool called the Keynesian Cross. So the Keynesian Cross, it's basically the 45-degree lines of these two-dimensional panels. So we have the graph plotting out Y and AE. The 45-degree line basically tells us at any given point on the 45-degree lines, there will be equal values of Y and EX, or AE. So when income or aggregate income is equal to 100, the aggregate expenditure should also equal to 100 on the 25-degree lines. So this is a very convenient visual tool, because if we combine this Keynesian cross with our previous aggregate expenditure functions, so if we are going to put the 45-degree lines with the aggregate expenditure functions together, you are going to easily see this graph will have this one point where the aggregate expenditures is equal to the aggregate outputs Y, which is this point right here. So the Y star, it's basically the equilibrium that we have been talking about since the beginning of this presentations. This is where the planned aggregate expenditure equals to the aggregate outputs Y. Now the question is, how come we always land on this equilibrium? How come this is the equilibrium but not the other points? So let's try to find another point on the graph. Let's say y1. So we would like to ask the questions. What if the economy actually produced y1 instead of y star? Is that going to make any difference? Is the economy going to make changes? So let's take a look at the y1's productions here. So if we look at the graph, y1 basically represent a very low values of outputs. Let's say $10. We produce $10 worth of goods and services, and if we look up on the aggregate expenditure functions, the blue lines, you will find that the blue line actually has a values, the aggregate expenditures in the economy, much higher than the $10 productions of Y1. And the question is, how do we know? Well, it's pretty simple. If you are going to look at the graph very carefully, the dotted lines, the 45-degree line actually represents where Y is equal to AE. When Y1 is equal to $10, and you look up on the 45-degree lines and trying to look to the left, you will find that when AE is equal to $10, it's where the 45-degree line actually land on when Y1 is equal to $10. But the aggregate expenditure function, the blue line, actually suggests when Y1 is equal to $10, the values of aggregate expenditure will be much higher than $10. So now the question is, well, what does it do with the story here? So remember the intuitive story that we told earlier. When the aggregate expenditure is actually greater than the aggregate output Y, when people are going to buy a lot in the economy, when the firms and businesses only produce not so many, well, the firms and businesses will ultimately have to sell their inventories in that current period. But when the next period come again, the next year or next quarter come again, firms and businesses will find out that they don't produce enough to satisfy the demands of the economy. And that's why, at the end of the day, the aggregate outputs will slowly shifting to the right. Or, I would say, the aggregate outputs will slowly increasing in the economy. So firms and businesses will start adjusting. Now, let's take another point and see why Y star is our equilibrium. Let's say now the economy is producing at Y2, and Y2 suggests maybe the economy is now producing $200 values of goods and services. Well, if you look up on this Y2 output, you'll find the 45-degree lines, it's actually having a much higher value than what the aggregate expenditure function suggests. So in this case, what happened is we have the aggregate expenditure in the economy, it's lower than the aggregate outputs. So what it means is the firm is producing a lot in the economy, but not many people are buying the goods and services. And in this case, well, firms and businesses will find out that they have to store much more inventory than they planned it out at the beginning of the period. So in this case, firms knows that they are not selling the goods very well. And in the future periods, what happens is they will adjust their outputs. Well, output will slowly adjust and it will reduce in this economy so that firm will be able to plan exactly what needs to be stored for the future period to sell. So either one way or the other, when the economy is producing too much or producing too little, there will still be a tendency for the businesses and firms to make changes of their outputs. So when is the economy going to stabilize? Well, it will only stabilize at that one point, which is suggested by the graph Y star. And that's why we call this Y star a macroeconomic equilibrium in this model. And this equilibrium only happens when the planned aggregate expenditure equals to the aggregate output Y. Well, now the thing is, we can visualize this. But how do we compute this number? Well, to compute this equilibrium outputs values, we need a couple of informations. Number one, we need to know the slope of this aggregate expenditure functions. And number two, we need to know the intercepts of these functions to the y-axis. Well, once we get this number, we are able to calculate the equilibrium's outputs value in the economy. Let's go. So to calculate the equilibrium outputs with the given information in the previous graph, we're going to be defining the consumption functions here. So we have the consumption functions equals to 100 plus 0.75 times y. And we are also defining the investment spending in the economy, which is $25. So again, this I is a fixed number because we fixed the interest rate in this simple world. So firms will make their decisions whether to invest or not based on the cost for borrowing money. When interest rate is fixed in the economy, well, the total amounts of spending on investments will also be fixed. Now we are combining the two here to actually form this planned aggregate expenditure functions. So again, the planned aggregate expenditure is equal to C plus I. So we are combining the previous two pieces of information, which is the consumptions, to the investment spending. So we have consumption, which is $100 plus 0.75 y, and plus $25 from investment. So end up, C plus I is equal to 125 plus 0.75 times y. And on top of that, we're going to further define, because we know there is only one condition where the equilibriums will be formed. It's when the aggregate expenditure equals to the aggregate output, and C plus I is equal to aggregate expenditure. So now we are going to put everything together. We basically say here, C plus I equals to y, it's where the equilibrium is going to happen. Now we have one equation and one unknown y. We can simply solve this y by algebra. So the simple way to do it, it's basically put y on one side. So we have negative, 0.7y on the right-hand side, on the left-hand side right now. We would like to move it to the left-hand side, to the right-hand side. So we can subtract 0.7y on the left-hand side and move it to the right-hand side. So we have 1y minus 0.7y, 0.75y on the right-hand side. So the leftover will be 0.25y. And we still have the left-hand side with $125. So we're going to take care of the 0.25 from the right-hand side. We're going to divide it by 0.25 to make it 1. And at the same time, we're going to divide the left-hand side by 0.25. So at the end, we get this y value here. So the y is going to equals to $500. So this y, it's basically referred to the equilibrium y star in the previous graphs. So this is basically the simple math that we use to solve for the equilibrium outputs in the economy. Well, as you can see, well, this math is not difficult. But of course, we assume people who are taking the basic algebra should be able to do it. If you haven't done algebra for a while, I strongly recommend you to practice a few times and trying to give yourself a little review on this algebra. But now we have models that we can actually find the economy equilibrium outputs. So I think this is a very important starting point for us because in the next videos, we are going to not just to find the aggregate outputs, but we would like to also investigate what if there is some changes in the economy. So for instance, maybe there is a change of consumptions, or maybe there's a change of investment spending. How those changes in spending will affect the equilibriums that we found in this problem. So for now, we are going to basically say we found what's the logic of this income expenditure model. And we understand what the equilibriums, the macroeconomic equilibrium represents, and how to solve for it. We would like to investigate a little bit more about this model in the next video. I'll see you guys next time.